Right now, we have a situation where home prices in Florida continue to crash.
For years, Florida's housing market felt like a gold rush. Big investors, hedge funds, private equity giants, and real estate syndicates were scooping up homes faster than everyday buyers could even schedule a showing. Miami, Tampa, Naples. Entire neighborhoods changed hands with a few boardroom decisions. But now, something has shifted. In the first quarter of 2025, nearly 6% of all homes sold in Florida went to institutional investors. That might sound like a lot, until you realize that just a year earlier, it was closer to 7%. This is the sharpest drop in institutional investor buying in Florida since 2020. And what's even more shocking, these are the same investors who helped fuel Florida's pandemic-era housing frenzy. Behind this shift are forces powerful enough to make Wall Street blink: surging insurance costs, climate risk, falling rents, and an increasingly cautious investment landscape. But this isn't just about investors walking away. This could mark the beginning of a massive power shift in Florida's housing market, one that could open doors for everyday buyers, or set the stage for an even bigger shakeup. Because when the biggest players start backing out, it usually means they see something the rest of us don't. And what happens next could reshape who controls Florida's housing future. But why are they pulling out now? And what does this mean for people trying to buy or rent in the Sunshine State? To understand why investors are pulling back now, we have to rewind a few years. Florida didn't just become a hotspot for Wall Street overnight. It was carefully targeted, calculated, and seized. Back in the early 2020s, when mortgage rates were historically low and people were fleeing big cities for warmer climates, institutional investors saw a gold mine. Florida had everything they were looking for: booming population growth, favorable landlord laws, and high rental yields. These weren't your average house flippers. We're talking about massive investment firms, entities capable of buying entire neighborhoods in a single quarter. Their playbook was simple: buy fast, rent high, and wait for prices to soar. They zeroed in on places like Miami, Tampa Bay, and Orlando, metros with strong job growth and steady inbound migration. Demand was off the charts. And at the height of the buying frenzy, Florida ranked among the top states in the country for institutional investment. In some neighborhoods, regular homebuyers didn't stand a chance. All cash offers. No contingencies. Quick closings. It was like trying to outbid a casino with a piggy bank. For investors, it was a dream. For families, it was a nightmare. Florida's real estate identity began to shift. Homes weren't just homes anymore. They were income streams, portfolios, and assets to be traded like stocks. And for a while, everything went exactly according to plan. Rent soared. Prices jumped double digits year after year. And Wall Street got comfortable. But what happens when a boom turns into a balancing act? When the easy wins disappear, the smart money moves. And that's exactly what we're starting to see now. The numbers tell the story better than anyone ever could. In the first quarter of 2025, institutional investors bought just under 6% of all homes sold in Florida. A year earlier, that number sat at 6.8%. At first glance, that might not seem massive, but in the world of institutional investing, where billions move with a single decision, that's a serious slowdown. It's not just Florida either. Across the entire country, institutional investor home purchases fell to their lowest level since 2020. The only reason their share of total purchases ticked up slightly nationwide is because overall home sales were down too. In other words, it's not that investors were buying more, it's that everyone else was buying less. Florida, once a top hunting ground for these investors, is now seeing those same buyers quietly step back. In the Miami-Fort Lauderdale-West Palm Beach metro, the drop is clear. A year ago, 4.8% of homes were bought by institutional players. This year, 4.5%. Not a free fall, but enough to raise eyebrows among analysts. Meanwhile, other states are overtaking Florida. Alabama, of all places, now leads the nation in institutional investor share at nearly 11%. That's a dramatic shift in investor confidence, from sunny South Florida to new, less expensive hunting grounds. Because big investors follow yield, risk, and policy like a roadmap. And lately, Florida's map has started flashing red. This drop isn't just a blip. It's a signal. Institutional investors don't leave money on the table for no reason. When they start slowing down, it usually means they see something stormy on the horizon. But what exactly spooked them? When giant investors step back from a market they once dominated, it's never just one thing. It's a chain reaction. And in Florida's case, that chain starts with something almost every homeowner has felt: insurance. Over the past few years, insurance premiums in Florida have exploded. In high-risk coastal zones, they've risen fourfold since 2020, now reaching $7,000 to $9,000 a year for many homeowners. For ordinary families, that's painful. For investors with thousands of properties, that's a profit killer. Even in places like Tampa Bay and Naples, insurance alone can add $500 to $800 a month to holding costs. What used to be a predictable, cash flow-friendly investment suddenly looks like a shaky bet. But insurance is only the beginning. Florida's property taxes have crept up, operating costs have climbed, and rent growth, which once seemed unstoppable, is finally cooling. In metros like Tampa Bay and Cape Coral, rent increases have slowed or even reversed. This means investors who were banking on high returns are now facing slimmer margins, or worse, negative cash flow. And let's not forget the bigger economic picture: interest rates. The low-rate environment that fueled the early 2020s buying spree is gone. Higher borrowing costs mean fewer acquisitions and lower expected returns. Add in Florida's growing climate risk, hurricanes, floods, and mounting insurance claims, and suddenly the Sunshine State doesn't look quite so sunny from a balance sheet perspective. For many big firms, the math just doesn't work anymore. So they're doing what smart money always does when the tide changes: pulling back quietly before everyone else notices. But this retreat doesn't just affect investors, it ripples through the entire housing ecosystem. Florida's housing market used to feel unstoppable. Home prices soared, listings vanished overnight, and bidding wars became a brutal sport. But now, the momentum has cracked. Across the state, price drops and slowing demand are no longer rare headlines, they're the new normal. Take Cape Coral, for example. Once a symbol of the post-pandemic boom, it's now ground zero for the slowdown. Home prices there have plunged 11% in just 2 years, and more than half of current listings are underwater. That's not just a soft landing, that's a hard reset. Naples, Florida's luxury darling, isn't immune either. Its high-end condo market is cooling, listings are sitting longer, and price cuts are becoming common. Affluent buyers, once quick to snap up beachfront property, are suddenly cautious. Then there's Tampa Bay. Once flooded with eager buyers, the market is showing signs of stress. Prices are flattening, insurance costs are spiking, and demand has cooled. This isn't a crash, it's a reshuffle. While some markets are struggling, others are quietly holding steady or even gaining traction. Jacksonville is still benefiting from inbound migration. Punta Gorda remains surprisingly stable, buoyed by lower insurance costs and less exposure to hurricane risk. But here's the key: this uneven landscape makes Florida less predictable for big investors. For years, they could bet on broad-based appreciation. Now they have to be selective. And selective doesn't fit the bulk buying strategy that made their model work. Institutional buyers love uniform growth. What they're seeing now looks more like a patchwork of winners and losers, and that's not what keeps billion-dollar funds sleeping easy at night. And this shift in the market? It's already changing who has the upper hand. When the big players leave the table, it doesn't stay empty for long. Someone always fills the gap. For years, institutional investors crowded out everyday homebuyers, outbidding them with all-cash offers and lightning-fast closings. But with these giants pulling back, first-time buyers and small investors are finally getting some breathing room. We're already seeing signs of this shift. In metros like Punta Gorda, Gainesville, and Palatka, homes are lingering on the market just a little longer. And that tiny window can make all the difference for regular buyers. These hidden gem, inland markets have something that many coastal cities no longer offer. Lower insurance costs, more predictable pricing, and less competition from big money. That combination is starting to tilt the playing field. Small investors, people buying their first rental property or a second home, can finally make moves without going head-to-head with a billion-dollar fund. But not everyone comes out on top. Sellers in high-risk coastal zones like Cape Coral and Miami Beach are feeling the sting. Institutional buyers were once a safety net, a guaranteed source of demand. Without them, properties can sit unsold longer, and sellers may have to accept lower offers. Meanwhile, local governments could see ripple effects too. Fewer big investor purchases can mean slower tax revenue growth, less development, and shifting neighborhood demographics. And while everyday buyers might gain an edge in some places, let's be clear, insurance and climate costs haven't gone away. Those same forces pushing out investors are still sitting on the table for everyone else. But for the first time in years, the balance of power in Florida's housing market is starting to bend back toward regular people. And not everyone in the investment world is happy about that. When institutional investors make bold moves, they don't exactly announce them with a press release. They operate quietly, strategically. And right now, the whispers around Florida real estate are getting louder. Industry insiders say some of the biggest funds that poured into Florida during the boom are now quietly unloading properties, especially in high-risk coastal zones like Miami-Dade and Cape Coral. No fire sales. No panic headlines. Just a slow, calculated exit. This isn't a retreat with flashing lights. It's a quiet pivot. Because these firms know that dumping everything at once would tank their own portfolio values. So instead, they're doing it gradually, selling off weaker assets, tightening acquisition pipelines, and redirecting capital elsewhere. And here's where it gets even more interesting. They're not abandoning real estate altogether. They're just moving their bets. States like Alabama, which now leads the nation with institutional investor share around 11%, and regions in the Mountain West are becoming their new playgrounds. The logic is simple. Lower insurance costs, higher rental yields, friendlier tax structures, and less exposure to climate risk. To these funds, it's just math. But in Florida, this strategic pullback is leaving a noticeable footprint. Properties that once sold in hours are now sitting for weeks. Investors that once snapped up entire subdivisions are going dark. And here's the part that has everyone talking. Some analysts believe this is only the first wave. If insurance costs keep rising and rent growth keeps slowing, more funds may follow. Of course, not all of this is confirmed. Some of it is speculation. But in the real estate world, where there's smoke, there's usually fire. And if the big money keeps shifting away from Florida, it could reshape the state's entire housing future. What happens when Wall Street walks away from one of America's hottest housing markets? The truth is, Florida's real estate story isn't over. It's just entering its next chapter. If institutional investors continue pulling back, we could see a gradual cooling of home prices, especially in areas that relied heavily on bulk investor demand. Coastal metros like Miami, Naples, and Cape Coral may face slower price growth or even further drops if fewer buyers are competing at the top. That shift could open doors for local buyers who were previously shut out. Instead of facing a bidding war against a hedge fund, more first-time buyers might actually have a chance to win. But this isn't just good news. The forces driving investors away, insurance hikes, climate risk, and rising costs, aren't disappearing just because the big players left. They'll still affect every buyer and seller in the state. We might also see rental dynamics shift. With fewer institutional landlords snapping up single-family homes, rental inventory could level out, or even ease in some metros. That could mean more balanced rent prices in places like Tampa Bay and Miami, where institutional landlords once set the tone. Meanwhile, inland hidden gem cities, like Punta Gorda, Gainesville, and Palatka, could become the new battleground. With lower insurance, cheaper prices, and steady demand, they may attract smaller investors and individuals looking for stability and value. And then there's the bigger picture, Florida's climate challenge. Rising insurance costs are no longer a footnote in the housing conversation, they're the headline. If the state doesn't address the risk and cost crisis, institutional money may not come back the way it once did. So what's next? A market that might feel less like a Wall Street monopoly and more like a local chessboard where individuals, small investors, and cautious buyers call the shots. But make no mistake, this isn't just a market shift. It's a power shift. Florida's housing market has always been more than just numbers. It's been a symbol of opportunity, of boomtown dreams, of wealth built under endless sunshine. But for the last few years, that dream has belonged mostly to institutional investors, the giant funds that saw Florida not as a place to live, but as a balance sheet to build. Now, for the first time in years, that grip is loosening. The data speaks clearly. Institutional investor home purchases have fallen from 6.8% to 6.0% in just a year. And behind that drop lies a perfect storm: soaring insurance costs, rising taxes, slowing rent growth, and mounting climate risks. These forces are reshaping Florida's housing landscape from the ground up. The coast is no longer a guaranteed goldmine. Inland markets, once overlooked, are becoming the new focus. And for the first time in a long time, regular buyers are no longer completely outmatched. But this isn't just about buyers and sellers. It's about power. For years, a handful of big players dictated how fast prices climbed and who could afford to compete. Now, with their retreat, Florida is at a crossroads. Will this open the door to a more balanced, accessible market? Or will new players step in to replace the old ones, repeating the cycle all over again? One thing is certain: the rules of the game are changing. And the people who understand this shift early, buyers, renters, small investors, may be the ones who benefit most in the years to come. Florida's housing future won't be decided in boardrooms this time. It'll be decided on the ground, in neighborhoods, in open houses, and in everyday decisions made by people who actually live here. The era of easy investor dominance may be fading, but a new era is just beginning. And the question everyone should be asking is, who's ready to make the next move?